Good morning and welcome to our webinar, Shape Your Risk Management Strategy in Manufacturing. This is a very special collaboration between Marsh, EY, and Chubb to talk about the seismic shifts and emerging trends that are taking place in the manufacturing industry. What are the impacts to the risk profile and how can you manage them? And ultimately, what are some of the risk management, mitigation, and transfer solutions that you can apply to better protect your business? We're fortunate to be joined by three experts today. I will let them introduce themselves in just a moment. My name is Christina Vigilante. I lead sales and the corporate and commercial client segments for Marsh in Asia. And I will pass it to Atul first just to introduce himself.
Thanks, Christina. Hi, guys. This is Atul. I lead supply chain and consumer sector across ASEAN for EY. I've been in consulting, helping clients in this sector and for a large number of manufacturers, pretty much from last 23 years, hardcore supply chain guy, helping manufacturers build their capability from a process improvement standpoint, mitigate the risk associated to how the emerging technologies are impacting and obviously COVID, crisis management and business continuity planning. So happy to bring that perspective for today.
Jessica, over to you.
Thanks, Christina. Hi, everybody. I'm Jessica So. I head up the Analytics Solution team in Marsh Asia. So our team focuses on doing analytics using data from Marsh within and also external data to help clients to understand how they can buy insurance more effectively, be it minimizing the cost of risk or minimizing the volatility of losses exposure to the business. So in my presentation later, I'll talk about the process of how we do risk finance optimization to help you make better decisions in risk financing, and including insurance and self-insurance.
Excellent. Thanks, Jessica. And Kevin, over to you.
Okay, thank you. My name is Kevin Stevens. I work for Chubb Insurance, so from the insurance company side of things. I look after industry practices at Chubb, which is an area that focuses on industry verticals. So we look to try and provide one-stop shop, multiple insurance solutions for these one industry. The industries that we focus in are manufacturing, we look at technology, we look at life science companies, we look at healthcare companies, and we look at the clean tech industry. So today, I'm bringing the perspective from the manufacturing side and the solutions that are available for manufacturers.
Fantastic. Thanks so much. So we've got a ton of experience here across kind of all aspects of manufacturing, all the way from performance and design through thinking about the application of analytics and then how you best insure. So it'll be a great discussion. We are reserving at least 30 minutes at the end for Q&A so we can make sure that we get all your questions answered. So we would strongly encourage to just send your questions through the chat as they arise, and then we'll pick all of those questions up at the end. So without further ado, Atul, very excited to pass it over to you to start us off.
Thank you. I'm also pretty excited to share some of the different aspects of how manufacturing industry is building kind of management strategy which helps them minimize their risk and also build their productivity as we go along. If you move to the next slide, please. So when we analyze within EY, looking at various different manufacturers' profile, we recognize that there is an importance which everybody looks at it from a supply chain resilience perspective. Clearly, COVID has revealed that it has not been a priority prior to this. And again, while it was hanging in somewhere within the supply chain as an important aspect for most of the organizations, that we've seen many of the manufacturers, when we looked at typical best practices of having contingency scenario planning in place, the teams, especially which are distributed, have clarity on what happens when a BCP is initiated. Single consolidated view for the visibility was kind of lacking as well as when we drive a reactive response to such disruptive events, those resulted into much more challenge because of the earlier points that I mentioned. We also found that there's constraints around the way that standardization of the processes do exist. And last but not the least is there is a whole lot of digitalization and the system changes which are required in order for us to be able to handle both the risk associated to manufacturing performance, the other as well, the exposure that those digital transformations were bringing in from a cyber, from an operational technology risk, because the dependency is significantly increasing as we go along. And COVID has clearly revealed that the more we are dependent on individual manpower, the more challenge that we hit when a situation like COVID comes in, and working with clients to make sure how that kind of gets mitigated in ways where I think we all team up for looking at that. If you move to the next slide. So looking at the key trends in the manufacturing sector, and it's been never more important to make sure that efficiency in the manufacturing operation is high. There is a significant pressure, both from a perspective of making sure we are able to produce what our customer wants, and also at the right margin and the right profitability that is required. So manufacturing performance kind of builds the cornerstone in the middle of it, and companies have more and more critical focus towards it to make sure that that part of the business is delivering the invested ROIs that was always planned. But it is not easy, because we see companies getting more and more bogged up with challenges and an associated risk for those challenges to meet what those ROIs or what those benefits that were expected from it. So if you look at it, underperforming operation is the topmost risk if we look at it. The workforce capability gap is generating another challenge within the manufacturing. Inconsistent performance, especially visibility of the performance, is generating a challenge. Clearly, when we look at manufacturing, it cannot work in silo. It has to be an integrated and connected program between how the sales is putting in a demand and how manufacturing is generating necessary products which are being sold, and not generating the products that are easier or with longer runs. So associated pressure on the cost as well as capex is never been higher, and remains to be challenged, because I think later Joe is going to talk about the visibility and the data aspect of manufacturing organizations. If we look at it, when we looked at OEE, which is an operational efficiency for manufacturers, an average is sitting around 55%, which means we are losing roughly almost about 40+% in an average manufacturer. Clearly, the best of the breeds are performing higher than 85, and a top quartile sitting at 77% based on the EY benchmarking that we constantly do for them. So while there is a huge gap, this generates practices which in turn generates the risk within the manufacturing organization, which the firm either picks it up by building efficiency improvement programs, digitalization activities, or as a collaboration in terms of making sure they're getting the right level of risk mitigation through some of the things that we will share later in the subsequent sections. As we go to the next slide, please. What we have also looked at, it's not easier to build this as an objective. It needs to be a tangible, measurable way that you go through this journey, where you're looking at what is resulting into that sort of loss that we talked about, and how you progressively build from a phase 1, phase 2, phase 3, phase 4 kind of approach with measurable metrics around it across business to make sure that this is excellence program or excellence initiative which is sustainable. Because the challenge always happens is organizations do attempt internally to minimize these risks by taking over these programs, but they have not thought through and planned to become a sustainable aspect of it. So a few things like underperforming operations. I did talk about fragmented approach, lack of standardization, and not having the right data do contribute as what we see in the market. Okay, next slide, please. I did earlier mention the technology and emerging industry 4.0 is truly changing how manufacturers operate. There is a whole lot of emerging technologies as well as the value generating use cases which are helping these organizations. So yes, there would be a level of help by virtue of some of that. But again, this needs to be picked up in a more constructive way, along with making sure that you have a performance of improvement on the process, coupled with digitalization, coupled with well-managed business continuity, and this needs to be circumferenced around with the entire risk management framework of how you are getting yourself covered where things are not able to completely come into the control of the organization. So smart daily management, energy areas, few other aspects that we've been helping clients to build those value mechanisms for them and designing their smart manufacturing in there. If you go further, look, the companies have invested and digitalization does generate P&L and balance sheet impact. Clearly, revenue growth reduces expenses, inventory write-offs, and planning efficiencies. Again, how it actually builds up over time is important. And as I mentioned, this needs to be thought through to make it more sustainable. Go to the next slide, please. The journey needs to be taking all the three aspects if you look at it. The workforce is very important. So you need to simplify the way that you operate. You need to understand the things are changing. People are becoming more health conscious, society conscious as we go along in a manufacturing world. So simplification of what a smarter workforce could be built in your process is important. Standardizing of the process as well as automating and digitalizing to reduce the dependency are three key steps throughout the journey that is important. We go further. There are some examples in which there has been connections around it to make sure that in this particular case study within ASEAN, the efficiencies were where it was focused on, but the efficiency could not be fixed without people, without the digitalization and the process aspect. So if you look at it, there were simplification of culture and behavior observation, standardization of realized changes and benefits. As we said, there were certain level of things which an organization was in control and hence generated some success factors there. And some of them, they were actually looking at how the risk management in the manufacturing entity could be managed, even beyond these efficiency programs, so that they are well covered through both aspects of the stuff. Go further. Digitalization, as I mentioned, is important, and hence linking digitalization to a business outcome was important. In this particular case study for a manufacturing client, building a holistic manufacturing solution was important. Driving decisions using that solution was important. And the last but not the least, building an organization and the adoption so that this becomes important throughout and it's no longer being a push from the top, but it is well adopted by the operational team on the ground. So clearly, simplifying, standardizing, digitalizing as a key components of the journey. Multiple use cases who have demonstrated this, but I'll just reiterate again, it is very important that yes, you pick up these programs, but you also look at a broader risk associated to the manufacturing, which could be making sure that you're well covered in a broader aspect from there. All right, next slide, please. Yeah, so this is another case study in which I think what we have done with palm refinery in one of the Malaysia organization built a manufacturing process before intervention, manufacturing process, post intervention, which has less dependency on the people, using the data to some extent, which we're going to talk a little bit subsequently, drive accuracy of quality, drive reduction in wastage, decrease in the prediction errors that we generally are facing around when the manufacturing systems are going to bog down, and hence would result into supply challenges, which overall then has an impact of what we can serve our customers. So in a very integrated manner, how digitalization could be addressed, as well as how it can actually impact the organization, was well felt as a part of this project. All right. I think with that, probably Christina, I will just summarize this and hand it over, which says, now you guys need to do is start thinking about how you get visibility, how you get your asset utilization. The immediate next is getting into predictive aspect of it, use that capability, that digitalization and enhanced ways of working that we help organizations. And from a beyond perspective, think about lights out, AI-directed supply chain, building insights, intelligence, and autonomous aspect of the supply chain. With that, I will pass on to Christina, which will tell how this encompasses into an overall risk mitigation aspect. Christina, to you.
Thank you, Atul. Really appreciate that. And as you were discussing everything that you're seeing in the manufacturing landscape, it just really made me think that manufacturers are currently balancing in this very precarious position where they're having to weigh trade-offs between capex investments, their fixed costs, and then also perhaps some of the mechanisms that are in place to protect their business as well. So there's this liquidity notion that they have to manage, and there's also all of the considerations around improving their processes and upgrading their systems so that they can be competitive in the modern landscape. And so, of course, in this pressurized environment that we're operating in with COVID-19, everyone, I think, has been re-examining their expenditures and thinking through what's the best way to free up capital for investment, but at the same time, make sure the business is protected. And sometimes when we think about insurance, we think about it from the perspective of covering our maximum foreseeable loss, or our insured loss, what the maximum insured loss would be. But of course, that doesn't contemplate all of the other aspects that are at play, right? In terms of potentially customer loss, lost growth, loss of confidence in terms of your investors, and so on. And so there's really a lot that needs to go into the decision making. So we're very fortunate to have Jessica So with us, who leads our analytics practice and thinks through kind of these aspects and more on a daily basis, and can talk us through all those considerations as to how best balance. So Jessica, over to you.
Thank you. Thanks, Christina. Yeah, I guess if Melvin maybe move to the next slide, you'll be able to see that actually it kind of linked together with from Artu's presentation about how we a manufacturer can improve their processes, control to try and mitigate the risks and make enhancement and make sure the operation is smooth. So it's really amplify in the COVID-19 world, right? Everyone wants to survive, and Christina has made some good points about how do you use your capital most effectively? Do you invest in control, mitigation, and then once you even understand all the risks that come to your business processes, there will still be residual risks that you have to decide whether you use your balance sheet strength to retain them, or try and find a way to finance this risk. And one of the ways, obviously, through Marsh, we partner with our underwriters to find insurance solutions for those risks. So yeah, some obvious risks are property damage risk, product liability, general liability. These will be like main concerns for manufacturers. So we will do that, the analytics to try to help the clients to quantify this insurable risk. But at the same time, also think about what is your risk tolerance? Can you also sustain the other uninsurable and unforeseeable risks? So if we turn back to the attention to, okay, the risks that you can transfer to insurance, how do you then make sure that you are really structuring the insurance to be the best risk finance structure? You're not transferring too much risk. You can use your balance sheet to retain some of the risk. You make sure that the insurance is covering the most unexpected risk, the capacity in the market, hopefully cover your MFL, in circumstances that is unforeseen. So unfortunately, the insurance market also needs to survive, and it has been hardening for the last 2 years. So in this kind of coupled with economic uncertainty with COVID-19 and also a hardening insurance market, what do you do? How do you make sure your decision of risk financing is correct? So this is the concept of what we're trying to bring out, risk finance optimization. So Melvin, if you can move to the next page. So yeah, what is risk finance optimization? So traditionally, when you identify that, okay, this is the residual risk that I cannot mitigate, what's all of the controls and enhancement of my operation, still with that in place, it will still be, there's still be residual risk. What do I do? So your risk finance optimization is a process, it's an analytics process that we provide an unbiased assessment of an insurance program structure, which will be useful to finance your risk within your risk tolerance, and only covering the risk that is necessary, so that you're not use unnecessary capital just on insurance, but also on other parts. So you can use those residual capital on other risk control and mitigation methods. But let's concentrate on our risk financing on insurance. Ultimately, we want to give you an idea of what program best fits your financial objectives. For example, optimizing the total cost of risk and reducing the extreme tail exposure. So I'll talk you through the process or the journey through the risk finance optimization. So we will move to the next slide. So this is really the approach we'll take to talk to our clients through this, to understand how we can design optimal structure to finance your risk. So first of all, the first baseline is really to establish what is your risk tolerance first. So if you go to the next slide, Melvin. So we do a financial analysis on your actual financial performance, past and future. So what is your expected earnings over time? What is the shareholder sentiment over time, over future periods? So what is the present value of your business worth? And so to actually understand what is the volatility that you can take with your business performance, your finance performance, and also future projected financial performance. This really form a baseline of what is your risk tolerance overall, not just insurable risk, but any other uninsurable risk and also other unforeseen risk that running, the cost of business can result in. So that's the first step. Then we'll go into now next step. So thanks, Melvin. Now we go into more targeted modeling into the risk that identify. Let's say property risk, it has to be one of the main one. Like you have your assets to run your manufacturing process, make sure that operation goes smoothly. There's building, there's machinery. So let's use that as an example. But this process also applies to all sorts of other risks, so liability risk, even cyber risk, other emerging risks as well. So the first step, risk modeling would be a very statistical actuarial way of calculating the risk. So if we move to the next slide again, Melvin. So well, fortunately, if you partner with Marsh, we have a whole database of market data. So that would give a good base of experience losses of the manufacturing industry as a basis to do the statistical modeling. Think about your own company loss experience as well and your exposure, and also some additional scenario, for example, based on the risk engineer's survey idea of what is the MFL, maximal foreseeable loss, or probable maximum loss. Those will be the extreme cases that can happen. And then in geographies that has nat cat also exposure, we'll do the nat cat modeling as well to think about the whole risk profile of your losses. So not just all the day-to-day kind of operating smaller losses, but also the extreme circumstances to build a statistical distribution. So then you're asked what else? What do you build this for? The idea is that you will then, when we already look at risk tolerance, we understand which kind of area or amounts of loss you can comfortably retain within your balance sheet. But then those that you are not beyond your financial strength, then we'll try and find a solution in the market to ensure this risk. But then also try and gauge what is the fair premium pricing for this risk to be transferred at a cost-effective way. So then we can go to the next step. And so this is also an illustration of how the loss distribution will look like. We look at it in a probabilistic way. Okay, let's go to the next step. So then we understand we need to come up with a metrics to measure what is optimal. How do you optimize it? You can optimize it by premium, optimize it by retail, decreasing the tail risk, or you can understand the economic cost of risk, which is what we are introducing here. Okay, so let's go to the next slide to have a think. So two concepts. One is total cost of risk. Usually, when you buy an insurance policy, there is premium. But then you also have retained losses. So retained losses plus insurance premium is your total cost of risk in this definition. Every time you buy insurance, you're paying something. So obviously it looks like that on the left-hand side, it is a cost to your organization to buy insurance. But obviously there's missing some elements really, right? When you buy insurance, the volatility will reduce. So on the right-hand side, we also measure the economic cost of risk, measure how your volatility may reduce. So that's overall will give you a better picture of how much losses you retain, how much premium you pay, and what is the volatility impact when you buy this the insurance. And our approach really helped to measure this. And the one obviously that reduces the economic cost of risk most is the most cost-effective way, measuring by this metric. So we can have a look at then the next step. Once we calculate all of this, we can then think about designing an optimal option. So next page show just an output kind of illustration of, we compare our current structure to our option 1, option 2 of different deductible and limit. And then we think about what is actually the economic cost of risk. You can see how the option will reduce or changes the economic cost of risk, not just the premium. And then you want to reduce the volatility on the top right-hand side picture. It's really like an efficient frontier, reducing the volatility as the most cost-effective program, with the most cost-effective program. And all of this is within your risk tolerance, so that you know that all of these options will not, even if you take up any of these, will not impact your balance sheet significantly, and business go on as usual. So obviously, this measure the volatility of risk and make sure that there are the coverage will get to cover the most extreme risk that is can exist in your operation. So that is the whole RFO approach. So I'll just close my presentation with a few case studies of how our clients have used this or how we have helped our client to look at their program structure using risk finance optimization. So this first case study is a multinational electronics contract manufacturer. So like I said in the beginning of the presentation, it's a hardening insurance market. So premium is going up at renewal. So clients are really looking to us to think about, okay, how do they really optimize the program? Hopefully on the way, save some costs as well, economic costs. So we look at the risk tolerance. We do exactly what I have mentioned. We look at their losses, build a loss profile, loss distribution. And what we found is that the higher deductible and limit considered by the clients are actually relatively small compared to the risk tolerance. So they can actually take up a little bit more deductibles. But then actually the program that they are buying at the moment, the premium are reasonably priced. What we have suggested to them is that with an increasing deductible on the CAT exposure, they can actually result in saving of a total cost of risk of 6.5% compared to the current insurance structure. And this all still sits within comfortably in the risk tolerance. So it may not necessarily be a premium saving, but it is in a way of financing the whole cost of risk. This is a way that we can look at to help save the total cost of the operation. So then the next one is we also do like risk finance optimization to really think about alternative insurance or risk transfer structures. So for example, this one we look at a parametric for a client, and although the parametric parametric is weather related. Yeah. So if it's not really giving a lot of cover for the extreme loss, but it is a very good value cover for that deductible. So it's almost can use it as a deductible buy down structure to protect the lower band of risks. And it's and then basically starting the traditional insurance at a higher retention to save some of the cost of the insurance. So I'll just close with the last slide. Next slide is just thinking, because risk finance optimization, a lot of the time we look at traditional insurable losses, but as you see, as Achu has mentioned as well, that there's a lot of emerging risk, right? From our risk resilience diagnostic survey, these are the 6 identified risks. No prize for saying pandemic is one of the biggest, but then there's climate, cyber, geopolitical, emerging tech, regulation. So not all traditionally insurable, but then the risk finance optimization way of thinking about it, it will still help of how do you then finance this risk, or whether you have the financial strength to absorb it and for how much. And just to link up to the next presentation from Kevin, we look at our Marsh clients. Within Marsh clients, for example, one of the risks that are highlighted, cyber. Out of all the cyber policy that are placed by Marsh in Asia, 6% are from manufacturers. So there are solutions out there that can be covering some of this risk. And on that, just do a plug on our statistics and data. So do come to us. We can provide some benchmarking information for manufacturer and for other industry as well. So with that, I finish my presentation, and I think I'll pass it to Christina first, and yeah, move to the next presentation. Thank you.
That's excellent, Jess. Thank you so much. Actually, that was a great segue. I think we can go right into Kevin and some of what he's going to talk about, how Chubb can help provide very specific industry-focused coverages to address those market solutions. So Kevin, over to you.
Okay, thank you. If you go on to the next slide, please. I'm going to start off with Chubb and just our focus in manufacturing. So as I said in the introduction, we've been looking at various different industries, and we try and build insurance solutions to respond to the emerging needs and evolving risks and exposures faced by the industry of our focus. And in this case, in the manufacturing world, we've certainly seen quite a lot of change and some complex needs in this manufacturing sector. So if I just look at 3 subjects here about the manufacturers' relationships with their suppliers and their customers, through sort of 4.0 and the connectivity, we're seeing increasingly interdependent relationships with the supply chain and connectivity through suppliers, but also through the customer base. We're seeing manufacturers make less product to be put onto the shelves ready to be sold, but more just-in-time deliveries, both in the supply chain, but also in the supply of the product itself. Through the product mix, we're seeing a number of manufacturers obviously introducing a lot more technology into their product and providing additional service with that product to specific needs and meet customer requirements. And then, of course, on the factory floor itself, we're seeing a lot more introduction of technology around automated systems, the use of artificial intelligence, Internet of Things, and with that, a high degree of reliance on technology through that operational manufacturing process. And therefore, with that emerging needs that we need to really sort of review and look at. Key drivers already been touched on by Atul, sort of around the affordability and the efficiency and the productivity gains of a manufacturer, critical in today's environment with smaller margins, a lot more competition, and with the use of technology being able to create greater efficiencies and productivity. If we look through the history of products, I'm taking this from the view of a manufacturer makes a product, and then when they sell those products, what exposures do they face from their customers and their clients around potential loss? And we've seen a shift here emerge through the industrial revolutions, where traditionally products were manufactured one over one, and therefore product liability would be sufficient really to cover the body injury and property damage exposures. But once you start to introduce mass production, and then you have much larger batches, you have exposure to things like recall, where if there's a defect in a batch, it's going to affect multiple products rather than just one product. And therefore you need to consider recall insurance. Through 3.0, with the introduction of more technology into products, you have the greater exposure of products not working, not because necessarily of mechanical failure, but because of technological failures. And therefore, your product doesn't work or do what it's supposed to do. And then with the introduction of 4.0, there's a lot more connectivity between product, your product, other products, the manufacturing chain, and therefore a lot more exposure to digital enhancements to the manufacturing process, but also to the product itself. So the introduction of cyber. So really we've seen a shift of insurance product solutions that are offered by the industry move from covering more of a physical product towards a digital product. Next click. And one example I use for this is really a vending machine. So stepping through the whole process here, a vending machine used to be on a platform. It used to have dispensing of drinks, etc. And what we found is that replacement of those drinks required the delivery guy to turn up, check what the contents were, disappear, go back to his truck, go and get the exact number of bottles and come back and replace it, then move on to the next vending machine. Today's vending machine are way more intelligent. They automatically communicate product that's been sold. So the replacement, replenishment really is just turning up with the required volume of product that needs to be replaced. You can remote manage the pricing, so you can change the pricing to drive your sales. So connectivity through Wi-Fi, but also the payment systems are fully integrated. It's no longer just a coin. You can use multiple different payment mechanisms, and so that opens up the exposure to unauthorized access, to cyber exposures, to unavailability if the system is down or the vending machine is broken. So a lot more productivity expected from the vending machines today by their owners, and therefore facing a wider degree of exposures just from a simple dispensing machine that you have on the platform. Okay, next slide, please. For us, our focus is on industries. We look at all types of manufacturers, so that could be the brand name, it could be the component supplier, or in our territory, we have a lot of contract manufacturers as well that look to fill in that supply chain. Distributors are also covered. We have an assembly product focus on manufacturing, but we also have very specialist products for the technology industry. We've got a separate product for the life science industry and another one for the clean tech industry. So with each manufacturing division within those industries, they have very specific, unique needs, and we build the products to cover those emerging exposures and unique needs. Okay, next slide, please. Here, just summarizing for what we've introduced into the market for manufacturers is our assembly solution. And really, it's sort of a packaged policy combined with some monoline solutions for property and environmental insurance that really is designed to grow with the emerging needs of this industry. So next slide, please. What I'm starting off with here is to sort of group together the three core products that are in our main solution. So manufacturers face a broad range of first and third party risks, and we can group those into 6 coverages. So next click. the risks identified from, two more as well, please. So the risks identified from the exposures that these policies cover really evolve from third parties, consumers, and sort of customer and clients. So that could be the end user, but if you're a component part manufacturer or a contract manufacturer, that's also going to be companies down the supply chain as well. So if you're an auto parts tier 3 sort of supplier, then your customer is going to be the tier 1 supplier, not the end user. And then with the digital risk and exposure, you're also facing enterprise risk, where the networks and the data itself in the organization, the industrial computerized systems, could come under attack from unauthorized access. So the traditional public and product liability on the top right segment really traditionally exposed to and covers the bodily injury and property damage exposures. And then also those policies and our policies extended to include product recall coverage. A more evolving coverage on product liability to cover those gaps is errors and omissions, or manufacturers' E&O policies. This is really there to respond to the financial loss suffered by the customer or the downstream end user arising from defective products. If the company is manufacturing products specifically to specifications, say a contract manufacturer, then if they don't make the product in accordance with those specifications, there is a breach of contract. Or if they don't provide the services in accordance with their promise, they could potentially be exposed to a breach of contract. In the top left-hand section, looking at the cyber insurance, this is a combination of both first-party and third-party coverage. An organization like a manufacturer does have information technology systems, but they have now a lot of technology sitting on the factory floor. And with that, they need to be able to protect both their networks, but also the industrial computerized systems against unauthorized access. So first-party coverage to respond to some of those. And then to a lesser degree, personal information that is compromised or network security liability. So this is where manufacturers have connectivity to their suppliers or to their customers, and then through unauthorized access could damage other people's computer systems. That exposure is handled by this. So our solution of Assembly is looking to provide more of a holistic approach to a manufacturer, especially in the lower range with revenues of up to, say, $100 million, of trying to really put into one policy an integrated solution covering multiple exposures. Okay, next slide. I'm going to touch a little bit just on some of the exposures of why traditional product liability policies aren't suitable. And it's the traditional policy that most people buy, but thinking that product liability will cover everything, but it doesn't. Primarily, it's focused on the bodily injury and property damage, and it won't respond to those losses. It could be related to software errors or defects in the technology integrated into your solution that causes downtime or continued mechanical breakdown of the product you supplied. Contract manufacturers, we insure a contract manufacturer at the moment that supplied a part to a tier 1 supplier, and it's caused significant outages and financial loss for the defect that our manufacturer supplies to their customer. Potential such that there's an $11 million claim arising from a $400,000 batch of products because of the consequential loss of all the increased cost of working and the inspection and the removal, the repair, the replacement of our insured's product built into the ultimate end product. Okay, next slide. There's a lot of talk at the moment around the globe about cyber and unauthorized access. And for manufacturers, typically they've been off the radar, but that's really changed over the last 18 months. Manufacturers typically don't contain or look after a significant amount of personal information, and so traditionally haven't been a target of the bad actors because the value of the information they retain is of little value to others. But what the criminals have realized is the impact to the factories, to the manufacturers, if they're able to shut down their entire operations. So we've certainly seen quite a large increase in ransomware style attacks on manufacturing companies, because the incentive to pay the ransom is quite significant. The introduction of a lot of robotics technology, artificial intelligence into the manufacturing process, linking that with older legacy systems in the manufacturing line, creates exposure to the manufacturer because it can take quite some time perhaps to bring them back onto line and restore those systems. And so therefore the outage time presents a high exposure to the manufacturer, but also an increased risk where the bad actor is prepared to try and play bluff with those manufacturers and demand high ransoms. Okay, next slide. The Chubb has online, we basically have put out on Chubb Cyber Index all of our cyber information from the claims that we've paid, all of our proprietary data from year zero in doing cyber insurance. And we've been doing cyber insurance for over 30 years now. So with that, any company can tap into this system to look at what sort of loss scenarios are driving claims, what impact it has on the business, and whether that's internal matters or external matters that are driving the claims, but also just the number of incidents that have occurred and how much they've cost. So next slide, I thought it'd be worthwhile in these two slides, my final two, just to show some statistics to back up what I was saying before. So here we have 2016, the set of bar charts at the top. The focus there by the bad actors was really on the healthcare industry, professional services, financial services, where they, as you would expect, they hold a lot of personal information, credit card information, financial information. And so we see a lot of hacks in the past to try and gain access to that personal information. Manufacturing was not really a target. Fast forward that to 2020, and manufacturing have shot up to number 2 in the unauthorized access world for us and the reported instances in our entire cyber book of business. Professional services are still their number 1, and that's mainly because of phishing type attacks, a shift from trying to steal personal information, but to trying to induce companies to making payments through clicking on links and social engineering type demands. The manufacturing one is really driven by the ransomware payments and targeting the factory lines of shutting those factories down. Okay, next slide. This slide's on the left-hand slide. The left-hand bar chart sort of talks about the exposures faced and the claims that we've paid in the cyberspace for manufacturers. The biggest segment here of 60% represents business interruption and the costs of recovery of your systems. So by far the biggest part of the claim for a cyber claim for a manufacturer really relates to business interruption. And that aligns with those ransomware demands where it shuts down the factory line and an hour, a day, or a week will have significant impact on that business. The next largest segment is the forensics costs. So just go back as quickly. The forensics cost being 20%. And then for the normal first-party costs in a cyber policy are minimal really for a manufacturer. And on the right-hand side, that's summarized with the incident response costs. The incident response are those first-party costs that are there to deal with a cyber instance. And so first of all, you'll have the forensics that deal with what went wrong, how bad, how much damage has been caused, and then what needs to be done to close it off and rectify the solution. But still by far, so roughly $230,000 is our average claim on all manufacturers that we've paid a cyber loss on. The percentages down on the bottom right basically show that compared to all other industries, the forensics cost for manufacturers is about 25% less than, say, professional services or healthcare. But the big percentage differentiation is in the other costs, which are really more to do with personal information. Because manufacturers don't have a lot of personal information, there's not a lot of costs incurred in dealing with credit monitoring or notification of individuals that their information has been compromised. Okay, final slide. The holistic approach of the package of solutions that we have, covering both the product liability, the financial loss E&O, the recall, but also the cyber, has built into it a number of first-party coverages to help mitigate losses. And the cyber one is an important one because most companies, especially in the smaller manufacturing space, won't already have relationships with a lot of these companies to help mitigate loss in the event of a cyber attack or a cyber incident. And so the policy that we have is linked to a vendor program that helps mitigate potential losses So we have an app. As soon as there's a loss, we have access then immediately to a number of different vendors that can help mitigate the exposure. Okay, next slide. And so my final slide, just once again highlighting the different types of products for manufacturers, depending on what industry you're in. And with that, our focus on trying to build flexible policy offerings tailored to meet the client's needs. Okay, thank you. Back to you, Christina.
Fantastic. Thank you so much, Kevin. So actually, maybe we can just stay on that slide because we have a couple of questions that were sent in advance. So if we can just go back, Melvin, to the prior slide. We have a couple of questions that have been sent in advance, and one of those actually kind of speaks to exactly what you're sharing here. The question was from someone who is working at a palm oil manufacturing company. And their question is around what are the most practical insurance policies that they can purchase in view of the fact that the market is hardening. So I think at one point you kind of showed us those 6 areas. And so maybe you can help us understand what's most essential and then how they build up from there, depending on what aspects of their business they feel they need to protect.
Sure. Okay, I can start off with that. I think then maybe it's over to yourself as the broker. But Jessica certainly pointed out in her session really the risk tolerance an organization will have as to what they can retain themselves and then what they look to try and transfer to an insurance company. And definitely not every risk can be transferred to an insurance company. Some are just non-insurable. But with that, yes, the market is hardening, which means that the cost to buy insurance is becoming more expensive for various different reasons. So having done the analysis of what risk you're looking to retain and then what value can I still buy from the policies, I think you have to then build that up from the essential level from ground up. So what is going to be the biggest impact to your business, and therefore what are the most relevant policies that you need to be buying? Not necessarily just for palm oil, but for all manufacturers, certainly the property insurance covering the physical assets. Without those, then you're going to struggle to be able to continue to do the business. If there is a fire or catastrophe happening, then you have the business interruption insurance arising from that physical result. If you're selling product, then there's a liability exposure that product can cause bodily injury and property damage. So product liability and property are probably 2 of the essentials. Top onto that, you have marine insurance, which is covering the transit and the cargo. Particularly depending on the terms of trade, then that's of paramount to cover once it's left your factory or your premises on the way to the customer, then that definitely needs to be insured. Beyond that, you start to look at covering the corporate for directors and officers insurance or perhaps for cyber. But really, then you also have to look at the environment you're selling. Where are you selling the products to? Are you selling them just into your own territories or selling them overseas? So you need to think about perhaps political risk insurance or even trade credit as well. So I wouldn't say there's necessarily one sort of complete solution for that, other than to advise, make sure that you have a good broker. And that's why we've got Marsh sort of organizing this, because Marsh are probably the best place to advise which of the products most suitable for your organization, and then tailor a program across all of your insurance needs as to what risk can be retained and what can be transferred in the marketplace.
Absolutely. Thanks, Kevin. Jessica, is there anything you would want to add on to that from your analytics perspective?
Yeah, I would say that just now the risk finance optimization presentation, I was focusing quite a lot of the insurable risk here. So more of the traditional risk that we talk about here, property risk, liability risk, marine cargo risk as well. But then, yeah, a lot of the methodology itself actually helps to really quantify risk. So for the traditionally uninsurable risk, I think it just really needs a real understanding of what is the real risk potential. So we start to branch out to do a lot more on analytics or on the more uninsurable or non-traditional risks already to really understand what would be the impact to the business. So it's not necessarily that, yeah, like what Kevin said, everything can be transferred, but then how do you deal with those risks? Without quantification, you don't really know what is the exposure. So I think that would be kind of one of the advices that I would say, just yeah, come to us. Obviously, we're happy to help, or yeah, make sure that you think about definitely quantification of the risk, not just rating of risk. Traditionally in a risk register, you rate as this risk is more severe than that risk, but it's the business impact that's definitely very important.
That's great. Thanks so much, Jessica. As you both said, right, it starts with having a complete view of all the risks that your business is exposed to and what the potential level of loss could be, and then understanding which of those are regulatorily required, or is it contractually required by your vendor suppliers, or the environments that you operate in. And then it comes down to assessing your tolerance, of course, as to what you're willing to retain, and what you want to find a more efficient option for, to move risk off of your balance sheet. So absolutely, that's something that we can help you think through. So we did have another question as well. There was a question around best practices for business continuity plans, particularly in view of the COVID-19 pandemic. So I think, Atul, you touched on this a little bit, and then Jessica, you with the risk resilience diagnostics. So Atul, maybe we can come to you first, and then go to Jessica for additional views.
Sure. So look, from a way that the risk mitigation and the BCP aspect does come into play significantly in a manufacturing environment. I think COVID has really brought this to life, is to have that BCP created for a lot of variations, because I think generally it has been for simple things like technology or cyber related stuff, but as a broader operational risk, BCP has been significantly growing. So if a supplier is not able to actually provide me what I need as a raw material to produce, and what are the other aspects where I have to build those business continuity to tomorrow if I have one person in the plant who is infected with COVID. So building those business continuity plan and embedding them into an operational process where the operational people are able to activate that is becoming critical. And as a part of the stuff that we have helped some of the clients build that as a part of their crisis management approach, that as soon as any of the situations like current era in COVID is happening, how you can build those, what triggers the communication, what triggers the BCPs associated to it. But these are at a certain level, these BCPs, as earlier Jessica mentioned, are indeed subjected to how regularly are we activating them, how regularly we are coaching around them, because otherwise the exposure remains always there, that it is one Excel where you have marked some risk, and it's people don't understand how to actually run a continuity plan if that risk really becomes real.
Jessica, anything additional?
Yeah, thanks, Christina, thanks Atul. Maybe I just, not too much more to add, but I guess it's a process for, it's, nowadays you have to think long term as well, right? It's, pandemic maybe just like these 2 years, it will come down. It may come back again, and then another, for business continuity, you have to think really long term, like for example, climate change. It is going to change the world over the next 20, 30 years. And how you survive through this, you need to really kind of think about it in a very long term, not just, I know traditionally business focusing on short-term kind of profits, right? And short-term goals. But possibly, I'm sure a lot of companies are thinking about ESG in their mind, environmental, social, and governance, and a longer term view to really building that resilience over a longer term. So I just adding that part. I think part of this outcome of our business risk resilience diagnostic. So again, our plug, come to us. We can do some business resilience diagnostic for you as well.
Yeah, thank you so much, both of you. I mean, I was just going to mention that it's a very timely question, because we just published our risk resilience diagnostic findings, and we actually surveyed, somewhere around 2,000 clients around their feelings of resilience relative to the happenings of the last year. And I think Jessica in her section highlighted those 6 key areas. But one of the findings of the survey was that many businesses, although they're thinking about these areas, they're doing some degree of planning and preparation, and some are further along on the spectrum. Most felt that they had not done sufficient scenario testing or financial modeling to really understand the impact on their business. And just to pick up on Atul's point, it can start as small as one person on a factory floor that has COVID. And then that can bring your operations to a halt. So really understanding through assessment and through modeling the points of interconnection in your business, and how you can kind of make the BCP plan more robust to provide for that. So I think it was a huge learning for us this past year. And many of those findings are published in our risk resilience report. So we'll see if when we share out the replay, if it's possible for us to attach some additional information on that risk resilience diagnostic as well. And just picking up on that point, there was a question in the Q&A, will the slides be shared after this webinar? We won't be sharing the full slide deck, but we will share a replay, a recap, and a few excerpted slides as well. So you can keep an eye out for that. And if there's any kind of further information, feel free to get in contact with any of us. We've got everyone's email addresses listed here, and we're always available to help. So we did have one more question that came in, and let me just read this here. I think this might be directed to Atul first, but Atul, you presented kind of on the realization of benefits from the investment in emerging digital technologies. Would that investment contemplate costs in terms of managing potential risks that would arise from accelerated digitization and kind of a fundamentally different way of conducting business?
Yeah, so digitalization in most of the manufacturing units is not a small investment. It's a significant change in the way that the whole operations needs to switch to. Again, digitalization has its own flavor of just doing a technology and analytics related digitalization, or actually automating the factory to be able to get dependency off from the manual operators. So the level of impact and the risk for each of those different scenarios is significantly different that it actually generates within the operational success of that digitalization initiative. Digitalization, while it generates operational risk, but it also generates the risk associated to the exposure that it gets. And I think Kevin really touched on Industry 4.0, that cyber attacks and other exposure, which previously was not there because they were humans. And now we are trying to automate through control towers, through centralization of operations, where somebody is running a digital twin and is able to open and close the wall for you. Recently, we heard what happened in the pipelines in the US. And those are the level of risk that digitalization does bring to the manufacturing organization, which does require a level of, I would say, coverage, as well as also the business continuity planning of if that happens.
That's very helpful. Thank you, Atul. Now, one topic that's always of great interest to all of our clients is claims and claims experience. And Kevin, as Chubb is one of the largest insurers in the world, I'm sure you have a kind of a robust repository of claims experience. So is there anything you can share with us from an insurance perspective as to where you're seeing either claims volume or frequency accelerate in a particular risk area for manufacturers as a result of kind of the recent business environment for the last year and a half?
I guess one I highlighted during my talk was really related to the cyber exposures. So definitely the increased focus on the bad actors of targeting manufacturers because of their potential ability to pay, or the risk of having their operations shut down. That's certainly one. When you're touching on the business continuity, got me thinking about responsibility as well. So definitely during COVID, a lot of manufacturers we've seen take a closer look at the force majeure clauses in their contracts and their responsibility and liability to their customers around the pandemic. Quite a lot of, surprisingly, the force majeure has really been targeted more at earthquakes, acts of God, that type of scenarios. And we've seen a couple of claims and disputes come through related purely to delay in delivery. And so other manufacturers in certain territories that hadn't been locked down, requiring parts to be supplied by a country that had gone into lockdown and factory not being able to operate, those force majeure clauses in their contracts didn't protect those manufacturers and their liability to supply product, and therefore exposed to sort of the errors and omissions, the financial loss style claims. So we've seen a few of those come through. The pure product liability type claims, less in the manufacturing, but we've obviously seen a drop off in certain types of liability claims because there's less people out and about, so the typical slip and fall have disappeared. But what we have seen is quite a high demand in some of our industries in the manufacturing space, such as in the life science, the medical device and pharmaceutical manufacturing has obviously increased. A lot of our technology-based customers, the use of technology, their revenues have increased significantly. Their ability for remote working, especially around in the tech and the support side, looking at how they react to supplying their service or continue to provide those services on top of their products is a little bit easier. But as far as increased claims specifically come out of, say, COVID, there hasn't been a large jump or bump other than in that manufacturing cyberspace.
Very interesting. That's very interesting. Yeah, it's certainly a very hot area. So there was one more question, and I think, Jessica, I'll come to you on this one. So it was around the acceleration of third-party risks. So, historically, Asia as a region has not been as litigious as some of our Western counterparts, but we certainly see that with the rise of Asian multinationals, with manufacturers increasing their footprints to be global, that there is a rising kind of third-party liability trend, certainly across product liability and other areas. Is there anything that we are able to look at specifically, either from a modeling perspective or otherwise, to help clients or manufacturers who have not traditionally been as steeped in this, to get their arms around what that exposure might mean to them from a balance sheet perspective?
Yeah, thanks, Christina. So yes, you're right. Yeah, Asia has just never been really a litigious environment. So third-party liability, general liability is not really a big concern. But then obviously Asia is really leading the world as like the hub of the multinational clients. So we do see a lot more clients now have overseas exposure, and so there are definitely the need to really understand what when they sell their products, manufacture in other parts of the world, what are the change of the risk profile in terms of liability. So the way that we look at liability would be two ways. One is purely kind of experience-based, so database. So we'll look at industry, so manufacturing industry around the world, where we can collect information on the different type of claims, how claims manifest, and then build a statistical distribution and think about the loss profile. The other way is to really, through a risk consultation, really talk about directly with the client, what are the scenarios. So when you are doing your ELM or risk identification process within your company to look after risk management, we partner with you to understand what are your key risks, and then we build bespoke tailored model for that scenarios to think about your financial impact. So it's very specific to the client circumstance when we do this quantification. So the key is still like understand your risk and then quantify it before you can really find a solution, whether to mitigate it, control it, or transfer these risks.
Thanks, Jessica. Kevin, anything additional from you?
Yeah, I'll probably just like on the subject of liability, I don't disagree that across Asia is definitely less litigious compared to other territories such as the US or Europe, or even selling product into Australia. But one thing that I think we have noticed across the insuring manufacturers in Chubb is that there's greater requirements now for the entire supply chain to be held responsible for their contribution towards the loss. In the past, maybe the original brand manufacturer or the tier one companies would have been holding that sort of that cost themselves, but we're seeing a greater increase in passing that subrogation or that responsibility down the supply chain, right down to the component manufacturer, and doing that through driving through contract the requirement to have insurance, but also passing back the responsibility to the ultimate creator of the defect in that component supplier. So across Asia, we do see a lot of companies that are either contract manufacturing, component parts, or subsystems that will end up in an end product, and then being held responsible for the defects or the manufacturing quality that they supply. So we are seeing recovery claims made against them, whilst not direct from the end customer, because that end customer may be anywhere in the world, but the aggregated exposure of loss and cost by those downstream being passed back to the subcontractors and to the suppliers.
Kevin, maybe just to pick up on that, and then we'll see if any additional comments from Atul. But of course, in addition to to your point, any property damage or bodily issue arising from the liability of a product, we've also seen in a number of industries, but manufacturing certainly included in that, a rise in product recall, right? Product recalls going on, and then of course challenging kind of situations from a market perspective because the costs of recalls are often so high. I'm just curious what you're seeing around that in terms of, do you see acceleration? Do you see a difference in the way, clients or insureds are responding to and preparing for that? And do you tend to see the focus more so on the reputational side or more on the financial side as it relates to the costs of recalling and replacing? So just any thoughts you have on that would be, interesting to share.
Yeah, sure. There's certainly definitely an increase in demand, and we see claims on the recall without a doubt. Now, traditional recall policies, on the most part, respond to the threat or actual bodily injury and property damage. And so with that, you have the obvious ones of products that have been tampered with, or pharmaceuticals that have a large degree or high propensity to cause bodily injury to individuals. And so therefore recovering those from the shelves is of paramount importance. So recall covering the costs to regain possession. There are a few standalone recall insurers. The recall that we tend to offer tends to be bundled with a product liability policy, but there are a few standalone recall insurers that have more expensive coverage offerings that may cover the costs of dismantling and reinstallation of those products. But typically what the recall doesn't cover is what I call perhaps the financial loss recall. So that there is no exposure to bodily injury or property damage, but the component doesn't work. It's not performing correctly, but it's installed into another product. And so you may have an example of a car, an automobile, that has a defective product in it. That product needs to be recovered, repaired, and replaced. And so trying to get coverage around the costs incurred with that whole program of the replacement of a defective part. We're seeing some of those claims come back into the manufacturer's E&O style policies for their responsibility for those downstream increased costs, but they're not traditionally covered by the basic product recall type policies. As far as reputational concern, the recall policies typically don't cover reputational damage, but potentially if you're a manufacturer that's supplying a product, a component part to another company, and that end customer suffers reputational damage, then that is potentially an E&O claim against the manufacturer that we'll be insuring. So there is avenues in some insurance solutions to cover the downstream reputational damage.
That's great. Very helpful, Kevin. Very, very helpful answer. So we're coming up, close to time here. So I think I'll close it out with one more question. But there's a lot that was discussed today, both from a performance management perspective, a modernization perspective, Industry 4.0. bringing, enhanced digital systems into the way you do business. And then of course, all of the risks that hang off the side of that, right? So maybe Atul, I'll start with you, and I'll see then Kevin and Jessica if you have something you want to add. But for someone who's sitting and listening to this webcast, and maybe they're a risk manager or a director of finance or something, how can they, I imagine a lot of what we're talking about requires cross-functional work, and getting different silos on board to work together. How can they kind of practically begin this journey in their organizations to understand kind of where they are, what the forward-looking plans are, and then how they plan for that from a risk perspective? Any thoughts from you, Atul?
So I think clearly there's lots which is changing. There's a lot to actually do within the organization, as I earlier mentioned, from a performance, standardization, simplification, and automating them. I think the key thing is for us to be truthful in terms of measuring and checking our own maturities to start with, because that would tell us where are the level of risk that we are still having, and probably will be generating, given the maturity levels, if they are lower and we need to go through multiple transformation journeys to actually attain the level that the peers are at. So look at how you're standing yourself as a maturity and comparing with peers to define what that roadmap is and what the associated risk of that roadmap is as a starting point, I would suggest.
That's great. Kevin, anything to add from you?
Yeah, there's probably two aspects to that. One is the digitalization of the products that are being manufactured, and so taking that into account of potential exposure they cause to the customers. But the other one is probably more on topic here of the question, is the digitalization of the factory floor, and with that the cyber exposure. So most companies will probably have an IT security manager that will look after the IT system, and then we have the industrialized computer system that's probably the key people managing that. Their priority is getting it up and running and little downtime, minimal downtime for maintenance, and making sure that there's real segregation between the industrial system and the IT system, so that if there is unauthorized access to the IT, it's not going to impact or gain access to the factory floor. So we're really looking at segregation, and then combined management and minimal connectivity to the internet or to the corporate networks.
Jessica, any closing thoughts from you on that?
Yeah, on digitalization, I guess operating technology and information technology both are really changing how manufacturers and other industry. Well, we as a broker and risk consultant will help you quantify the risk. We have got some cyber or network interruption models that we can also use to help you to understand what is the potential exposure, and then match it to your risk, the insurance product that can cover this risk. So yeah, that's my closing comment.
Excellent. Well, thank you so much. I want to say a big thank you to all of our panelists, to Atul, to Kevin, and to Jessica for sharing your thoughts and your expertise, and also for your offers of support, past the close of this webinar. Should anyone have any questions, on anything that was discussed, as mentioned, everyone's email address is listed here, and I don't want to speak for anyone, but I'm sure everyone would be very comfortable with you, reaching out and sharing any questions that you have or engaging in a dialogue. Thank you to you for taking your time to participate. We hope that we shared some valuable insights, and many thanks to our combined marketing teams for their support to bring this information to you in a succinct way. So with that, we'll close out the presentation for the day. As mentioned, we will share out a recap of what was discussed, as well as a replay of the webinar, and we'll see if we can attach some of those supplementary materials that we discussed around the risk resilience diagnostic as well. So thank you all for your time and your participation. It's just got a nice comment, great webinar. Thank you. Glad you enjoyed it. And take care, and we'll speak soon. Thank you very much.
Thank you, guys. Thanks.